1.2 million Kenyans sign up for this unit trust, and asset base is around 254 billion shillings.
1.2 investors currently in money markets.
Yeah.
In 10 years ago, they were just 84,000.
Yeah.
That fund manager, their basic work from the person at the front to the end person who's making this asset allocation and rebalancing, they are able to realize opportunities in the market and take advantage of it. The investments that you, with your money, when you go, because of economies of scale, you'll be told, no, yours is much less for me to give you this investment. So I would say it's good to be bold. It's good to do your own investments. You can get those rates, but you might miss out on opportunities that are coming in, coming out.
Yeah.
You might also just not be able to access some investment that a fund manager will be able to access because they're able to amass all this amount of money and reinvest it.
Welcome to another episode of Make Money, the podcast. And today we have a conversation that's quite close to the hearts of most of you, and this is around unit trusts and money markets. Money market funds would be sitting right in this investment universe. So we want to understand more about this unit trust business and the role that fund managers play and the importance of putting your money collectively. So essentially, a unit trust is an investment vehicle that pulls most of these investments into one fund where you give your money, I give your money, you give your money, all put in a pot and invested via a professional fund manager. And today, I'm happy to have a financial investment advisor with me here, Miss Belinda Kiplimo. Welcome to the podcast.
Thank you.
And thanks for coming through again for a second time on this podcast.
Yes.
Same conversation around unit trust and money market funds. And I would like to pick it up straight from where I just left that introduction around the role of a fund manager. And first of all, on whether we need fund managers with us, the numbers are quite telling on whether we do need that. 1.2 million Kenyans. And this is the September for the Business Daily, a piece by yours truly right there. And you can see 1.2 million Kenyans sign up for this unit trust, and asset base is around 254 billion shillings. And then with this, and looking at a decade ago, those numbers were much lower. The asset base was much lower. So what do you think has made unit trust that compelling that, we have quite a lot of people asking about them and wanting to get in? What do you think makes pulling our investments together and handing it to someone like yourself to manage? What do you think makes that a compelling offer for anyone?
Yeah.
Yeah.
You said it right, actually. We are talking about the 1.2 investors currently in money markets.
Yeah.
In 10 years ago, they were just 84,000. In 2 years back to today, that's 600% we've seen as growth.
Yeah.
But some of the things I can point out to is convenience. The moment you make an investment or anything to be convenient, it means anybody can just walk in today and be able to understand this investment and even be able to see it. So the convenience, I have personally seen it even as a practitioner, is before, to open a money market account, the form used to be this thick and so many other details that you need. But now with your phone, you're able to download an app for the fund managers who have an app, and you can open the account for yourself, or you can fill in a very thin form. You get your account in a day or even within a day or two maximum, and you're able to invest using your pay bill. You just need a pay bill number, the account number that you've been given, that's the money market account number, or you transfer through bank, and the next day your money has started being invested in a money market. And we are talking about this money being invested at double-digit growth. Right now, we're even having 16-17% in terms of the return in money market. So convenience being number one.
Yeah.
Number two is just that ease of entry and exit into a money market fund. A money market fund almost behaves as a bank account. Whereas a bank account, you can put in your money and tomorrow you withdraw, nobody gets to ask you why you withdrawing your money from your bank. It's the same with the money market. You can put money today, and tomorrow you clean all of it or take a bit of it. Nobody will come to ask you. It's all about you and how you want to run that money market account. So if I could leave it at those 2 points, I think that's what has driven the growth. And actually I have to credit also to media houses and the knowledge economy, because now as people get to keep hearing about these investments, they've been there 30 years ago. There was money market funds, but the more that even on your desk today you have a whole page that you're discussing these money market funds, you know how many people are going to read about it and tomorrow sign up. So you see that growth happening because of I believe these 3 points and many others.
And you spoke of return, which is quite attractive, but on the other side, something that not every fund manager wants to talk about is the 1 to 2% fees that as a fund manager fee attracts. So for an investment of around 50,000, assuming that's the investment I'm bringing, 2% is just around 1,000 shillings. And of course, we looked at the return you'd get, and working through the math, you still make a net return of over 4,000 shillings from your 50,000. So you would be approaching 55,000, at the end of an year, assuming that's the period of your investments. In terms of understanding the fees, how should we be looking at these fees? If someone is like, okay, I'm making over 4,000, but I've left that 1,000 shillings on the table. How should I be interpreting these fees, and how do these fees, or how are they applied in a sense?
Okay.
Yeah.
So once you're coming to a fund manager, I'd love to take you through a fund management flow. You come in, there's a customer service person, you open your account, there's an operations person. But for them to even get the 16% as a fund manager, they have analysts, they have researchers, they have all these other activities that are going at the back end who are making sure they are maximizing the opportunity. So there has to be a cost to that for them to even come and give you that 6%. Putting that aside, the 1.2% you mentioned about fund management fees, it's actually even provided for by the Capital Markets Authority, which is the authority that actually has a dual mandate of supervising the fund manager who provides the money market funds, and the other purpose is to protect your funds. So CMA caps the management fee at 2%. So one money market fund manager can be asking for 1.5%. Another one, the maximum is 2%. But now this, whether it's 1.5, whether it's 2%, it does not really factor in the return. You see the 50,000 you are calculating, and you got 4,000 shillings, 4,250 thereabout, using 16% return. That 16% that a fund manager has provided has already factored their management fee. So they've gotten beyond 16% for them to come and give you the 16%. So you, when you're looking at it as an investor, you should just put your amount, which is a 50,000, plus the return, which is a 16%. Then, of course, a tax of 15%, and you get your net return. So the management fee should not really worry you unless you want to go alone.
You spoke of the knowledge economy, and I like it, and allow me to grab one of the dailies here at Nation, and we go fund managers will display their rate of returns, their day yield, their annual rate of return, and there's a lot of detail offered already that someone can plug into and get into these investments. But you realize there's quite a number of players here. We have over 30 fund managers, each with their own unique fund, be it a money market fund, might be a fixed income fund. For someone wanting to get in, and the approach that I use mostly is someone ask about, unit trust, money market fund, whichever of the fund. I'll mostly refer them to either what I've used before or what I'm thinking of using, or I would share contact. But for someone coming at it, green in a sense, you don't have someone to speak to. It's all the knowledge that's then. It's quite a lot to choose from. There are over 30 fund managers. What differentiates one from another, and what are the factors as a person should I be looking at and be like, okay, I'll get into this one and not this one because I feel X and Y are my reasons. What for you are the top reasons in differentiating these products that I rather choose A instead of B, or even choose E instead of A, as much as it might be the big one or the talk of town? what are those factors that help explain the differentiation and where I get in and where I don't get in for you? Yeah.
Okay. We could start from this point, yeah? When you're thinking about getting into a unit trust, first of all, you ask, today Google money market fund providers in Kenya. As you say, there are so many, and they're actually required to publish on the dailies, whether it's Nation, Business Daily, all the dailies really. You first look at, are they licensed? Because first, for it to be called a money market fund, it needs to be licensed, and the licensor is Capital Markets Authority. And for you even to just get into Capital Markets Authority today on their website, you'll see all the fund managers. You'll even see their license numbers, and when they started, how much they're holding, where they're reinvesting. So that is information, I believe, as an investor doing due diligence, you should look at the license and all that. The second thing you should look at is convenience. You're a busy person.
Yeah.
And money markets have that ease of entry and exit. You need your money. How convenient is it to access your money? And how even convenient is it to get to contact this fund manager that you opened an account with? When you send an email, for example, do they have an email? Are they replied to? Is the app functional? Do they have the USSD codes? There are so many ways that you can access your account. How convenient is that for you? Because you can find maybe there are some people who have even multiple money market accounts, or even you as a fresh person, you might want to do maybe one money market, you want to leave some money, or the other one you want to use it often. Then that convenience, you ask yourself, if I don't want to access this money so much, perhaps you go to a money market fund provider who is not giving you all the apps and access that you may want. Maybe to withdraw, you have to write an email. And because you're busy, you will not be too quick to do that. But if it's money you need to access any other time, go for a fund manager who's giving you access on you withdraw today, you even get your money within the day or even the next day. So convenience is the second one. The third one is the rate. You work so hard for your money. And that money, you want it to grow a little bit. So if you're looking at your money growing, ask yourself, how much rate are they giving back to this money that I've reinvested? What gains are they? So you will find that we are doing between even 9% to 17% of all licensed fund managers. When you put your money, anytime you have money, every year there's an inflation that hits that money, and inflation is really reduction in the purchasing power of your money. So you've put your 1,000, your 10,000 today. In a year it will be less because of inflation. So if you're putting it to be invested, it should not be eaten by inflation. It should be above that inflation rate of the country. Let's give a scenario. The inflation rate currently is between 4 to 5%.
Yeah.
So if a fund manager's rate is 9%, it means your real return is reduce 5, so your real return is about 4%. That's your real, if you are to call it profit, that's your real profit. But a fund manager that's giving you 16%, for example, and you reduce it with the 5, you have 11% of net profit that you're getting, removing the inflation. So what return are you getting for that money you're setting aside to grow? So 3, convenience, license, and return. I would start there.
All right, great. And to go back to our example using 50,000 shillings and looking at your net return of around 4,250, assuming a rate of return of 16% for a particular period, there are some people who sometimes they might call themselves bold, or we might refer to them as bold, who might be, there's the 1,000 I gave up in fees. Maybe I would have pushed my return by myself at, to over 5,000 shillings. Do you think someone going at it alone, investing alone, say, I know you guys maybe go and find a fixed deposit account. I can do it by myself. I can go buy a bond by myself. Do I really need to be, giving up part of my assets to a fund manager, professional fund manager? Well, maybe I feel I'm good enough to walk this journey alone. Do you feel one lets themselves down perhaps for being a bit bold and, missing out on the opportunities presented by, a vehicle that can grow in terms of pooling? It's a pot that can be larger, than any amount I can have by myself. You might have 100,000 and feel it's compelling enough to get into bonds by yourself, or try to go to a bank and look for a fixed deposit rate of return. But we are talking of an asset class with over 450 billion shillings. So they are packing quite some power.
Yeah.
then do you think is there any need for boldness to be like, maybe I shouldn't be giving up the 1 to 2% and just do it by myself, and maybe seek the highest of return in a sense, but are there things I could be missing out if that's the path I choose?
Yeah. It's not a bad path to choose. But I would ask you this. Let's go back to you.
Yeah.
We are here for a half an hour or so.
Also, yeah.
After this, I believe you're going to do your briefs and whatever else you needed to do.
Yeah.
It will be 5, it will be 6 o'clock.
Yeah.
As we are seated here, the market is moving. I mean, the opportunities that are coming up, the opportunities that are leaving the market. Yeah? So if it is your money that you want to do and get the superior returns without having to pay to give a fund manager who get their management fees, that fund manager, their basic work from the person at the front to the end person who's making this asset allocation and rebalancing, they are able to realize opportunities in the market and take advantage of it. The investments that you, with your money, when you go, because of economies of scale, you'll be told, no, yours is much less for me to give you this investment. But the fund manager will be given, because how a fund manager works is, I put my 100 shillings, which is the minimum money market amount for some fund managers. You put your 1 million, somebody else puts their 50,000 shillings. All of us are treated the same. We all get the 16%. But I come with you come, somebody else comes with your 100,000 and they say, I want to do it myself. You'll get a bond, and the highest bond is 18.43% currently.
Yeah.
Then they'll go to another investment like a fixed deposit, or what you call the commercial papers. The fixed deposit that with 100,000, you will not get anywhere near 10%.
Yeah.
They'll actually tell you, for you even to get 10%, you need like 10 million or a lot of money.
Yeah.
But now, if you flip it back to fund manager, who you can put your 100,000, it can even be 99,000, and they will not ask you.
Yeah.
But with 99,000, with the government bond, for example, the minimum being 50, if you have 49,000 shillings, you won't be investing that 18.43.
Yeah.
And they won't want to know that it's just 1,000 less. So I would say it's good to be bold. It's good to do your own investments. You can get those rates, but you might miss out on opportunities that are coming in, coming out.
Yeah.
You might also just not be able to access some investment that a fund manager will be able to access, because they're able to amass all this amount of money and reinvest it. Yeah. However, there's also something I normally do, even when I'm talking to clients over the time that I have worked. I say, have a portfolio and split it. You can have some of your money in a money market fund with a fund manager, so that you're getting the opportunities. You're not losing out on those opportunities, and you're gaining on compound interest. And I hope we'll have a discussion on the miracle of compound interest.
We hope to have compounding and the time value of money.
And the time value of money, yes. And how that graph just gets to a point and just takes its own life. Then a portion of your other portfolio, you can now put it into taking advantage of you going to your own investments and taking advantage of the investing alone. So you're not losing out by going into money market funds, but also a portion of your other investments are going into the single investments, if I may call it that. Yeah.
So for you, it's pretty much diversification. Don't just ignore, the bonds, doing it by yourself. Have a money market fund and have something else.
Yeah. You have 250 opportunity to get 250,000 this year. 250,000, for example. You can put 50,000 in an MMF, leave it to grow. Then you have another 50,000 that comes in, look for a bond. You see, that way that's a portfolio of 100,000, but you have taken advantage of both. Whether the MMF, because the rate fluctuates, goes down from 16 to 15 and the bond is giving you 18, you're gaining in both ways. As
we come towards wrapping it up, I would like to go back to our 1.2 million Kenyans. We spoke of this number being less, a decade ago, being even less than 100,000 people. The asset base has equally grown the same way. We are at 254 billion shillings. And just remembering, just a quick retrieve of the data I might have. We are now seeing unit trust rivaling other asset bases, other institutions. The likes of the NSSF are, the assets in there are about to be surpassed very quickly by money market funds and unit trust and, the whole universe of collective investment schemes. We are pushing on 60 million Kenyans, but we only have 1.2 million Kenyans. what do you see as the potential? We keep getting the interest. Same way I was telling you, you'll get quite a lot of interest. People want to learn about these money market funds. How do we get in? What do you feel then is the potential? And another point, of course, to observe is banks themselves have started, doing unit trust. I think 5-10 years ago, I don't think any bank would entertain you if you went there with an idea of I want to. I'm thinking you guys can run a unit trust. They'll be like, nah, we'll just do our thing with fixed deposits, pay out from that and get sorted. What do you feel is we are perhaps still on the runway? What do you feel we can get to with unit trust and money market funds and the likes? What do you feel is the opportunity there?
The future is bright. Thank God for knowledge economy, right?
Yeah.
Because with knowledge economy, you just put money market funds. Tell me about money market funds. You'll get all the information. There's nothing that is really hidden anymore. Mm-hmm. Those opportunities just to know. You have to know someone to know someone to know where to invest and all that. That is available here. So I see with the knowledge economy and access of information, even unit trust just continuing to grow, because you see that ease of entry and exit, that is ability to just have the convenience of having your money market in your phone, your account, being able to see it on your phone, just like banks are able to do. I see that growing a lot. We've talked about financial inclusion over time, where the financial inclusion was focusing on the unbanked being banked, and that has happened very well. A lot of people are now banked. The second phase of financial inclusion, I believe, is coming up, and I talk about this a lot, is that we now need to move from people having bank accounts and SACCO accounts. There was also that bit of SACCO accounts being really growing, to the next level of people understanding investments and having investment account. And the basic investment I will talk about is money markets, because money markets are so easy to understand and to access. So after having a bank account, I compel people, after having a bank account, to have a money market account. Use it for parking a project. You have a project in the couple months or so. Park it there. You have money you just want to draw down slowly, withdraw slowly. Have it in a money market account, because you can withdraw at any time. So I see the knowledge economy really growing that. In terms of the assets under management or the money that's just invested in the money market. I also look at it when you are talking about the population of 60 million. Half of it is youth, right? I believe we are almost 50%. If I still call myself a youth, I'm not sure. But the youth are people who are coming up, they're understanding all this. So I see the unit trust growing a lot. And I believe that's one of the reasons, even banking sector, the commercial banks are coming back, and now you're starting to see them opening their own subsidiaries or unit trusts. And they were not really interested in it before. Right. So growth, I just see growth continuing in money markets.
Great.
Yeah.
And thank you very much, Belinda, for been on this podcast for a second time. Again, I might add that. And we look forward to having more of this conversation, looking back to see, the developments within the space, and we'll for sure catch up with you. Right. And that has been Belinda Kiplimo, a financial investment advisor. And I hope they've added quite the value in understanding money market funds. And this has been another episode of Make Money, the podcast, presented to you by the Business Daily. And catch us all across our platforms now. Business Daily Africa, Nation.Africa, you're on Spotify. You might see some of these videos on TikTok. New to this season, we've gone audio visual, and that gives you more opportunity to catch us, get some nuggets of investing. And Belinda, once more, thank you for being on the podcast.
Thank you for having me.